Happy Friday and good morning, everybody. Welcome to this week's long-form episode on Mining Stock Daily, brought to you by the Clear Commodity Network. Trevor Hall here, your host once again, bringing you a new guest, a longtime listener, first-time appearance here on MSD, and a friend of mine from Las Vegas, Mr. Adam Thurgood. Adam's been a good kind of sounding board for me since we first met a couple of years ago, but we kind of dive into just general market sentiment here and where these high valuations in these indices, major indices, are leading investors. What's the risk at the table here, and really what does a new Trump administration, those economic policies, look for him and his clients and the products that they provide over at Hightower Las Vegas. They do have an interesting product regarding to gold with variable high allocation to gold, higher than a lot of people might expect, and so we do dive into that as well. Great conversation with Adam, and I appreciate his time that he gave us this week. Special thank you to Visa Silver, Arizona Sonoran Copper, and Caliber Mining for the continued support of the podcast. And if you wouldn't mind, hit that like, subscribe, share, either on the podcast network or on the YouTube channel. It'd be much appreciated. We're en route to Vancouver this weekend. Spend a couple days there at some of the conferences taking place. Look forward to seeing as many of you as possible as we walk the floors and do a couple presentations at the Vancouver Resource Investment Conference. Always a fun time to kick off the year in Vancouver at this time with those conferences. So, all right, everybody, let's jump into my conversation with Adam. Have a wonderful weekend. Safe travels. Be well. All right, I'm really thrilled to welcome in our next guest as somebody I've thrown some ideas out to with regards to markets and investing here. Actually, since I met him in a macro conference in Beaver Creek about a year and a half ago. So happy to welcome in for the first time Mr. Adam Thurgood. He is a partner at Hightower in Las Vegas. So Adam, welcome to the podcast.
Thanks for having me on, man.
Yeah, first time, long-time listener, first-time guest, I guess you could say.
Yeah.
For introductional purposes, Adam, kind of just a little background on yourself, and then also the institution you're working with.
Sure. So been in the industry about 25 years, mainly on the advisory and portfolio management side of things. We've been managing discretionary portfolios for clients my entire career. Bounced around to a couple of different firms, but started Hightower Las Vegas in 2012 with a couple of partners from our previous firm. And we manage about $1.5 billion for wealthy individuals and some institutional business.
Okay. Las Vegas doesn't necessarily seem like a hotbed of wealth management, but it seems like you might have a little bit of a good niche there.
Well, we do get a lot of retirees that move to Las Vegas that are looking for a warmer climate to warm their bones in the winter. And we do have some wealth that's being generated from construction activities, gaming, and those types of things that are centered here. And we're getting a bigger and bigger tech presence also.
Okay. Well, obviously, I think tech is going to be somewhat part of this conversation, almost has to. But there's a lot of topics that we need to kind of dive into, and to maybe start this conversation. But Adam, I think we start things off with the big elephant in the room. That is the U.S. dollar. What a wrecking ball this thing has been over the last number of weeks, ever since the presidential election. Donald Trump coming in, a lot of concerns over tariffs and other economic policies of his. But it gives a sense of this strength in the dollar, and what ramifications are we seeing kind of slowly play into the effects within the global economies? What's happening that maybe has a bit of concern of yours, but hasn't necessarily played out to be up at front and center with everybody's screens quite yet?
Yeah, well, it's been interesting to watch the dollar, obviously, because it has such an important role to play in global economics. It's up about 6% in Dixie terms since the election. What I find really interesting is that it's only up about a little less than 3% against the emerging markets index over the same period of time. So the pain in the dollar has been felt in places like the UK and Europe and Canada more so than in a lot of the emerging markets of the world. And I think that is due to a variety of different factors. First of all, those economies are a bit of a mess, at least politically, the political economies in those countries. France can't seem to get a government together. Germany's having trouble. The UK seems to be having trouble. Trudeau just left in Canada. So part of it could be that. But also I think part of it is that Trump is not necessarily being as friendly to allies as he has been in the past, and has put in some tariff threats against what would have been unthinkable, 8 to 10, 12 years ago. Mm-hmm. But the dollar obviously is highly important because it has such a large impact on trade flows. It has an impact on global financial conditions. So as we've seen the dollar increase, especially against the developed world, it's tightening financial conditions, which ironically could make the markets more choppy, which then could give the Fed more leeway to cut rates and push the dollar lower at some point in the future.
Yeah. With the Trump administration just days away here, I mean, what is this having an effect on their economic policies? It doesn't seem like a Dixie at 109 or 110 is something that the Don would be terribly thrilled about.
Yeah, fundamentally, in order for him to reindustrialize the U.S., he needs a weaker dollar. We can't be globally competitive when the dollar is as strong as it is. However, there may be some rhyme or reason to why the dollar goes up first before it goes down. If you want to extract a pound of flesh from your international counterparts, having a super strong dollar is not a bad way to start. So I don't know if he's necessarily upset about the rise in the dollar today, but I think over time he wants to see a weaker dollar. Now, there could be some challenges to that because interest rate differentials are one of the reasons why we're seeing a stronger dollar. And Bessent has said many times in the past that part of the problem with Janet Yellen was that she was issuing too many bills and needed to extend duration. And if they do that and start issuing a bunch of coupons, that's going to push interest rates higher and will pressure the dollar upwards. So there could be, a one step back, two steps forward kind of mentality with the way that the Trump administration approaches the dollar.
Yeah. You did send me a pretty interesting graphic here as we continue to talk about the Dixie and its relationship with the S&P gold ratio. Maybe walk us through that. And I don't know if there's a way to share your screen or if you have it up. We're happy to do that.
Okay, so this is the S&P to gold ratio in orange, and then the Dixie lag 12 months in green. And you see a fairly decent relationship there. And this sort of ties into Julian Brigden's financialization theme. When the S&P is super strong, especially relative to a base money that it's a sound alternative, particularly to international investors, then flows would come into the U.S. to try and capture those S&P gains, which would push the dollar up and vice versa. So what we're looking at now is basically that S&P to gold ratio has gone sideways in a tight range for the past couple of years. So nothing in this chart is suggesting that you're going to see a massive surge in the dollar from here. In fact, it would suggest that the Dixie would be closer to 100 by the end of the summer. But there are other factors that come into play. I just find this one to be quite interesting because it's tracked pretty well over the past 20 plus years.
Yeah. Well, the relationship with the S&P and gold itself is quite dynamic because both have had incredible, rises in its values on price terms, single-handedly. You wondered, if that relationship alone maybe starts tweaking a little bit if we are to see higher inflation, higher yields, maybe risk-on markets start selling off. And whatever happens with gold following that, that ratio itself could become a lot more volatile.
Absolutely. You can kind of think of the S&P to gold ratio as the preference between investors' desire for productive assets versus scarce assets. And obviously, when you want scarce assets, that tends to be at a time when scarcity is at a premium or there's more fear in the system. So you could look at the S&P gold ratio as kind of a sentiment indicator of whether there's fear in the system or if the economy is humming and productivity and productive assets are desired.
Yeah. Let's turn the page and talk about inflation. We are recording this Tuesday morning, so we've got PPI data out this morning. As you and I chat, we await CPI data, which will be published tomorrow morning. So knowing that we're not airing this until Friday, we have no idea what CPI actually will have in store. But PPI was quite interesting, Adam, because it came in a little bit better than anticipated. And at first, risk markets shot up higher, but then as we continue along the day, there's liquidity events and markets are actually kind of in the red marginally. Not a huge sell-off. There is support here, but it wasn't, the rally was not supported. In fact, people were starting to sell equities off. It's been a difficult argument here to get your thumb on whether inflation is, how sticky is it? What are those leading indicators to kind of give us a sense where it will be in 6 months' time? And knowing also that there's this kind of this debate between, well, are President Trump's tariffs, are they inflationary, as a whole by themselves? And so how are you kind of watching this dynamic here in 2025 in the great inflation debate?
Well, I think there are a couple of ways to look at it. You can look at it versus Fed targets and get a sense of, whether the Fed is being maybe a little bit silly about cutting rates when inflation's still above target. We're looking at still a 3-month annualized core CPI at 3.6%. Super core, which takes out housing, is still over 4%. So that's a long way from the Fed target. And perhaps that's why we've seen interest rates on the long end go up, even though they've been cutting on the short end. And then if you look at break-evens, the 5-year forward break-even rate is about 2.3%. It's gone up a bit. That's above the target, but not too far out of whack. In fact, it's roughly the average of the last 20 years. So I don't think inflation expectations are necessarily unanchored, but they certainly, the actual levels of inflation are certainly above where the Fed would like them to be currently. Now, looking at where inflation might go in the future, we have a leading economic model that looks at leading inflation data, and it's suggesting a small uptick, not a major uptick. You're not seeing a bunch of different indicators, suggesting one way or another in dramatic fashion. So I think unless you get a significant economic boom, which could happen, we can talk about that in a second, or an unexpected recession, I think inflation will remain stubbornly high, but probably not go dramatically in one direction or the other.
Yeah. I think it might be important to note that core PPI bottomed about a year ago, and since then it actually has been on the rise pretty meaningfully. It's made a new higher high since then. So again, kind of watching this all play out, it's stubborn. I guess that's the best way to put it. So beating inflation, the bond market's having its say, Adam. Yields are rising, later stages of the curve. We're watching that. A lot of people are expecting that 10-year to maybe hit 5%. There can be ramifications at that breaking point as well. That would be a new high in relative terms for the 10-year. I might start thinking about moving some money into 10 years at that point. But, this move, the bond market is definitely having its say. It's an unusual thing to have the Federal Reserve cut its Fed funds rate by 100 points, while the 10 years also moving the opposite direction by 100 points in the same term. What is the risk here? What is the bond market telling everybody about the horizon?
Well, I think you can make the case that rates are still not excessively tight. If you look back kind of at economic history, the 10-year yield tends to sort of track the structural growth rate of nominal GDP. Looking at a 5 or 7 year average of nominal GDP, the 10 years had periods when it's below that and above it, but it tends to tag it quite often. We haven't tagged it since 2013. We've been below it, and that structural growth rate is still close to 6%. So you could say that we're still under, have a yield too low of about 1% still on the 10-year. And, there are some arguments against using something that simplistic. You could also take into account what the 3-month yield is doing and kind of create a blended average. And that blended average is roughly where the 10-year yield is today. So historically speaking, we're not at excessively high yields. Now, whether or not we can withstand a 100 basis point increase in the long rate with a system that's so indebted is up for debate. You're starting to see it obviously impact things like the dollar, and eventually it's going to cause some problems for all the refinancing that needs to take place between 25 and 27. So I think what the market is basically telling you is that either or growth is going to reaccelerate, and we're seeing some evidence of that in some of the leading indicators we follow, or rates are going up because Scott Bessent's going to be issuing more coupon. Either way, it's not great for the longer term runway of the economic growth story, because you're basically making it tougher for that to transpire.
So where's the growth indicators? What are you seeing? It sounds pretty optimistic.
Well, I wouldn't put a ton of weight into it, but what we've seen since the election is the leading indicators for employment have picked up quite a bit, and leading indicators for production have picked up quite a bit. Small business hiring plans, CapEx plans, CEO confidence, some of those measures have seen a dramatic boost since the election. So if we end up getting a production boom, that's really been the weak spot in the economy. The services area of the economy has been just fine. Even new orders have rebounded a lot off of their lows. So if we get a pickup in productive activity and the employment market stays strong, that could lead to another growth boom, which would also have inflationary impulses.
Okay. Oh, is it the great artificial intelligence growth boom? Any allocation to that, or are we still not there yet?
Well, I mean, that one's tough to figure out. I've seen estimates, ranging from this will be a total disaster with all this CapEx that won't amount to much revenue to, something along the lines of we won't have jobs in 5 years because all of this will be replaced. It's tough to figure out exactly what's going on. We do know for sure that there is a CapEx boom in hardware to support the AI infrastructure. But in terms of massive productivity gains that are helping the economy forward and helping us get out of this, debt mess that we're in, not seeing it quite yet.
Yeah. In another podcast that we published on the network, the Oil Ground Up podcast with Tony Greer, the latest guest mentioned that, and I'd have to go back to the podcast to get the direct numbers, but from what I recall, there's about 400, high performance data centers in the United States. It's expected that there's going to need to be 1,800.
Yeah.
So, you're talking fivefold here. Now that's going to take a lot of energy, obviously a lot of resources, and a lot of power to get those things going. But you wonder if just that alone, that digital infrastructure, is the growth itself, not necessarily the output that those provide. Or obviously data centers don't build new roads. They don't build new energy sources. They consume. They're more consuming than anything else. I still quite yet to understand the positive output that those things provide, rather than compared to the resources on the input side of building those things.
Yeah, the expectations are sky high. That's why a company like NVIDIA can have a market cap that's roughly 13% of GDP.
Yeah. It's wild. Let's talk about these equities. Again, Tuesday morning, these things are holding on. Like, it doesn't look good. The charts don't look good. Major moving averages have been busted through. Dip buyers are coming in expecting kind of more of the same by that dip mentality. But again, the U.S. dollar and the yields and the bond market, you and I have talked about this, remain increasingly stubborn. What are you seeing within the appetite for risk assets right now? The CPI could be a very important data point we see this week, but what are the risks you're seeing within the stock market?
I think the biggest risks in the markets are a combination of valuation and expectations. If you look at a variety of different valuation measures, it's almost impossible to say the U.S. market is cheap. So you take Warren Buffett's favorite measure of market cap to GDP, which he believes long-term should roughly equal 100%. And you want to buy with a margin of safety, so you want to buy under 80%. Well, we're over 200% today. So we're 120% above the margin of safety in that metric. Price to sales ratios are near record levels. CAPE ratios are insanely high. So there's a lot of concern from the valuation standpoint, but valuation is not a near-term catalyst. You can stay in excessively overvalued states for a long period of time. So then you look at the expectation side of things, and the consensus estimates on Bloomberg for S&P 500 earnings growth over the next several years are all double-digit. 10% this year, 14% the year after that, 10% the year after that. You can compound those three together, you're looking at 38% increase in earnings over the next 3 years. That's significant. So when you have super high expectations with really excessive valuations, you're introducing risk, a risk of a disappointment that causes a big air pocket underneath equities. Now, there are lots of different ways to assess whether the market is weak or strong. We're still way above 200-day moving averages in the S&P. We look at something that we call a sentiment model that isn't looking at market positioning in terms of, futures contracts and things like that. It's not looking at sentiment surveys, but it's just simply taking a look at market prices over the past X number of days, months, whatever you want to look at, and comparing it to the current price to see what the magnitude of trades in the past are in positive territory versus negative territory. And you create an aggregate of that, and that gives you a sense of whether markets are in positive sentiment or negative sentiment. And today we're still in positive sentiment. What we found by looking at not just the S&P, but a variety of different markets through this lens is that when you're in positive sentiment, not only are returns higher, but the risk is usually substantially lower. Now, we are in negative sentiment now in the international indices and small caps. I don't know if we're there quite yet in equally weighted U.S., but the S&P used to have a pretty large margin of safety before that turn point, and now it's much tighter. So I think if we went into a negative sentiment state, coupled with high expectations and valuations, I would be much, much more concerned.
How often have we been in negative sentiment? I mean, it seems like there's been these moments in the last, since 2022, there's been moments of like fear, but they last like 36 hours.
According to the way we've constructed the model, looking at it on a weekly basis, we've only been in negative sentiment 4 of the last 104 weeks. So
wow. Not
very often.
Yeah. I wonder just out of curiosity, what did that data provide in like 2022 when it was a bad year for the market?
Well, we would have been in negative sentiment. I mean, naturally, if prices are going down consistently, you're going to fall into that negative sentiment category. Obviously, the returns during 22 are pretty bad. It's not to say that if you're in negative sentiment, the returns will be bad, or if you're in positive, they'll be good. It's just that the average expected outcome is much better in positive sentiment than it is in negative, and the risks are much more magnified in negative sentiment. You can have really bad outcomes occur in that state.
Yeah. It's just fascinating because of the sentiment. It's almost classified as that numbers go up, Adam. In fact, even if you took risk off and looked at where yields were sitting right now, like money markets are anywhere from 3.5% to 4.5%. They have really good return, like as little risk as possibly you could have. but it's almost like too easy. Like the sentiment's like, well, why would I take risk off and put money at 4% when I could really try to beat the market? And if the S&P wants to go double digits, 10%, 14% next year, I bet I could get 18, 20%. I mean, that's where the sentiment is. Everybody beats the market. That is a dangerous proposition.
Yeah. But, if you look at historical real yields of equities, bonds, whatever, if you wanted a safe outcome, a real yield of 2.6%, which is basically what you can get in a long-term tip today, is a pretty good real yield. It's a pretty good inflation-adjusted outcome. However, I saw a poll on Twitter. I can't remember who did it. It might have been Andy Constant, that asked people what real yield they would need in order to put everything into that instrument. And it was, like 0 to 2, 2 to 4, 4 to 6, 6 to 8, 8 plus. Like the vast majority of respondents were 6 and above. Well, 6% real yields are really tough to achieve. So there is a disconnect about what is historically realistic versus what has been realistic over the past couple of years.
Well, but that dynamic, a money market account that gets you 4.5, Adam, that's incredible. Like, it feels like this is a moment in time where people how do I say?
Is it incredible? It's so easy. Because when I started my career, money market rates were over 6%. And if you ask someone who's in their 60s, the money market rates were, over 15% when they started in their career. So I think it feels incredible because they were zero for a long period of time. Right. And if the Fed ends up cutting rates, then those money market yields go down. But still, you are today, with inflation back below money market yields, you are getting a real yield. You are not losing ground against at least published inflation by having money sitting in cash in a safe security.
Yeah. It's almost like it's too easy, right? We hate easy when we can go beat the market by, the Mag 7 and buying super overbought tech stocks. Given this, maybe let's talk about those Mag 7 stocks, Adam. I mean, they are kind of showing signs of weakness here the first part of 2025. Again, we wait to see what happens if there is a meaningful dip to be bought. Or maybe it's just every little dip's going to get bought. But the importance of those handful of stocks keep these markets elevated, but that risk is just widening and widening. What was interesting here early part of the week is like tech was down, S&P was down, but Dow Jones was up. Could you make that argument that maybe we're starting to see a subtle rotation into value once again?
We could be, or it could just be an unwind of the wackiness of December when value stocks went down for 14 straight days. I think it's too early to really tell whether this is a sustainable shift. But you're right. I mean, things have gotten completely out of hand, especially in U.S. markets. If you take a big picture zoom out of the global situation, the U.S. is roughly 5% of global population, 25% of global GDP. We account for about 38% of corporate earnings, but yet our market cap is over 65% of world market cap. And that's mainly a result of the tech stocks, the Magnificent Seven, just getting excessively valued. Now, it's by far the largest sector in the S&P 500, by far. And it's gotten there because of lofty expectations about what's to come in the future. And almost all of that is tied to one underlying theme, which I find to be somewhat internally consistent with market positioning and pricing. And that's that there will be an enormous amount of energy needed in order to realize those earnings. So you've got the largest sector of the S&P with expectations for massive energy use, but yet the energy sector is 3.5–4% of the S&P. That seems completely internally inconsistent to me, unless there's some glorious new form of energy that's about to be discovered that puts oil and gas stocks into the irrelevant category. I don't see that happening. So that to me means that either we need to see a repricing of multiples in energy companies, or tech needs to have the air taken out of it.
Could both happen at the same
absolutely.
time? Yeah.
I mean, Julian always talks about the good way and the bad way, but there's also the both way, where the energy sector does well and tech goes down by 20 or 25%.
Yeah.
What's really interesting is if you look back over the history of the S&P 500, energy's been a pretty big weight in the sector up until, the last decade plus, decade and a half or so, where it was 10, 15, 20+% of the index. And most significant bear markets occur because of a spike in energy prices. And in the past, you were sort of internally hedged by a 20% exposure to energy within the S&P 500. If we have a similar situation play out today, that internal hedge doesn't exist because you've got, 3 to 4% in energy stocks in the index. So I think for most equity investors, they're heavily underexposed to energy, and that is one of our favorite places to be overweight. Not necessarily because we think energy is going to dramatically outperform in the next year, but from a risk management perspective, it dramatically reduces the negative impact that would come from an energy spike. And we all know that those events come and go. There will be another one at some point in time.
Yeah,
and they're cheap. I mean, they pay great cash flow.
Yeah, I was going to say that dividends are usually pretty good. Maybe on top of that, Adam, maybe if we want to be forward thinking, specifically with an energy portfolio, the window still seems very wide open for nuclear energy throughout the process, from explorers, producers to the utilities itself. And you kind of wonder if, as this continues to gain traction, obviously we're not there yet. It's taking quite a bit of time. But, the thought of nuclear energy being an increased part of the S&P in maybe 10, 20, 30 years' time, I mean, if you're a value type of investor, I mean, you would almost think that would be an almost place you'd want to be if you have that timeline.
Yeah. You just got to be willing to deal with some wild volatility.
Yeah. Do you have allocation to nuclear energy in some of your services?
We had a fairly sizable position in 2020. We started buying it, added to it in 21. We've scaled out of a lot of it. We still have some exposure, but we scaled out of quite a bit of that exposure it's probably 9 or 10 months ago. We still like the nuclear story, but we just thought that the stocks had come too far too quickly.
Okay. It seems like the equities itself have just done nothing for the last year, including the spot price.
Yeah. Well, the spot price, we could go into a whole discussion that I'm not qualified to lead about the difference between spot and contract pricing, and also the difference between the actual, the word just went blank on me, but the refined product, basically, that price has been going up a lot. I saw a piece on Twitter the other day from one of the guys that Macro Voices follows that showed the difference between the spot price and the conversion price, and it was significantly different. So you would guess that the spot price has to go up over time just because of the supply dynamics and the lack of supply meeting just basic demand, not even including the expanded demand that we're seeing by other countries restarting nuclear projects.
Well, we'll leave that conversation to Justin Hewen on the Going Nuclear podcast here on the network. So he's better suited for that.
Yeah,
well,
for sure.
Maybe let's talk about resources and maybe focus a little bit more on gold. And I think when you and I first met, you were kind of walking through some of the products that Hightower offers their clients. And one of the things that really piqued my attention was a product that has a much higher allocation to gold within the portfolio that most other people don't have. And this was a year and a half ago. I think it was a year and a half ago. The conversation was really quite centered on, okay, if gold's an important part of a portfolio, what's the appropriate allocation to the metal? And some people have that traditional, 5%, 10%. And you actually raised your hand and said, we have a product that offers up to 20, 25%. So that kind of piqued my interest. And so maybe talk about, instead of going in directly into that specific product, talk about the reason people should really consider having a higher allocation to gold within their portfolio. And on top of that, if you're going to have that higher allocation, is there benefits or in cons to having it within those paper derivative markets or actually the physical metal itself?
Good. All right, well, let me start with gold as a hedge first. You can think of, like I said earlier, you've got productive assets, which are, stocks, companies that are building things, making things. And then you have scarce assets, which would be something like gold or something like bonds if the environment was right. And this is great work from Gav Call that has laid this out. And so there are times where bonds are a great hedge to equities, and there are times where gold is a great hedge to equities. And roughly 50% of the time, bonds are a good hedge, and roughly 50% of the time, gold is a better hedge. Now, you don't size the positions the same way because of the volatility differences. You need more bonds in order to hedge equities than you do gold. So roughly 50% in bonds would provide a hedge to your 50% in equities, but you can do a 70%, 30% allocation to stocks gold because gold is higher volatility. Now, what environments would lend itself to gold versus bonds? Well, really, there are two main pieces of the puzzle that make sense to us when we look at it globally, and that is the number of countries that are debasing their currency and the number of yield curves that are sufficiently steep to lure investors to take risk by owning longer term bonds. And of the 20 countries we follow over the past year plus, roughly 90% plus are debasing their currency, and there are almost no sufficiently steep yield curves. And I read a piece this morning that said that the historically long-term average of U.S. Yield curve steepness is about 150 basis points between the 10-year and the 3-month. And even after this 100 basis point increase that we've seen in the 10-year, we're still at about 30, 40 basis points of steepness. So not even close to being at a level that really entices you to want to own a bunch of bonds. So when you look at it in that framework, it makes sense why gold has done so well despite U.S. real rates going up, because those two conditions have helped. Yes, real rates are higher, but they're not sufficiently high in the way that you need them in order to really entice someone to take a hedge in bonds.
Shit.
Buying a bunch of cash doesn't hedge, it just reduces your risk. It's different.
All right. So are you seeing people, some of your clients or prospective conversations you're having, prospective clients, is there more of a conversation about the position of precious metals within their portfolio, or are they still find the NVIDIAs and bid them up?
Yeah, we tend to be more value-oriented, conservative anyway. So a lot of our clients like the fact that there's a high allocation to gold, but we run at several different models, but in all of our models, except what we call the aggressor, which is just meant to, be balls to the wall, take some risk. Mm-hmm. All of those strategies have at least 8 to 10% gold. The defender portfolio that you were referring to earlier, that can have up to 30%. Right now we're in the 22% range.
It's variable.
Yeah, it's variable. That strategy was designed to give us flexibility to deal with different types of environments. So it can be 15 to 70% in stocks, 0 to 50 bonds, 0 to 30 gold, et cetera. It has some commodities. Can even take some volatility hedging ideas in there. But we have had clients that have been adamantly against gold. In fact, we lost a client about 9 months ago because he thought our gold allocation was too high.
Wow.
But it is what it is.
It's fascinating. I went end of year kind of how to my various, accounts. How was the year returns, and I tell you, my buy and hold gold portfolio outperformed everything. Like, it wasn't even close. And then I went back. It's like, well, if you just look at the gold price, it even outperformed the S&P and the NASDAQ by a couple percentage points. It was just one of those.
People don't realize that gold has more or less matched the S&P 500's return over the past 25 years. You tell someone that doesn't have market knowledge, and they would tell you that you're lying. But it's true. I mean, it's been going up at roughly a 7% clip for 25 years.
Yeah. But your cab driver isn't talking about the returns on Palantir. Right? He is talking about Palantir, not his gold holding. I think that's where we are. Yeah. I think that's a great sentiment indicator as well. I want to ask you about the gold miners here, and I know without knowing that you're an expert in gold miners, but you are a value guy, Adam, and like we're starting to see quarterly production numbers come in. Obviously, year end, incredible expansion of margins in gold production. Even if you're in that kind of mid all-in sustaining costs of $1,400 to $1,600 per ounce, and you're selling gold at north of $2,500, your margins are doing great. You're generating incredible cash flow. But yet, as I stand here doing this podcast on mining and exploration, markets just really do not care. They do not care. I've never seen such a strong business in every word of the sense. I mean, you have to go through company by company to see, where the skeletons are. But generally, the business of gold mining this is the best I've seen it in years. But yet the market is still kind of shrugging them off, doesn't really care, would rather be buying that dip in tech stocks and crypto.
Yeah.
What is it going to take for, generalists to kind of peek their head up, start looking down at the numbers, and maybe looking at gold mining as, I'm not saying a long-term investment, but at least maybe a trade through the volatility?
Yeah. Well, Dan Oliver, I can never pronounce his firm's name, Myrmikan. He put out a great piece today on that subject, and basically laid out the point that gold miners do great gold does great during the bust, not during the bubble, because there are just too many alternatives, and there's some unbelievably amazing verbiage in that report that I suggest everyone read. Hilarious. I mean, amazing. But basically, I think the answer to your question is that why would anyone care about a gold miner when those stocks that you've discussed are ripping higher? It's not sexy. They may not even understand that gold has done what it's done. And value investing kind of goes out the door in a bubble. People care less and less about it. But eventually, it will matter. If there is a bust, especially in the tech sector, people will start to look for other ways to make money. And it may not be the value component that brings them to the gold miners in mass, but it could be that enough value investors do come to the gold miners to push the price up enough to entice the rest of the people to grab a new Momo trade.
Yeah. Do any of your products have allocations to gold miners or even the GDX?
We have a few positions in three of our strategies. Okay. We don't hold any gold miners in the Defender strategy. That's simply the metal. But we do have some exposure there. We have less than we had last year, but we still have some exposure.
Okay. All right. Well, we are less than a week away from inauguration of a new president elect, although you can make the argument he's basically been president since the day he won, because a lot of the attention has been on Donald Trump ever since. But again, a little bit of speculation given his economic policies and geopolitical ideas and policies, Adam. You got to have your head on a swivel. If you and I were to touch base again in 3 months' time, say March or April, other than talking about the tremendous amount of powder you and I skied all season, on the economics.
It's not
Yeah,
snowing
hopefully.
where my resort is.
Oh, you got to come to Colorado then. We've been getting nailed. But what would you expect? What would you kind of expect that conversation to be like? Is there? It just seems like it could be. Jared Dilling calls it a potential Costanza moment, where the expectation is Trump comes in, and the economic boom comes up because that's what happened the first time. But that Costanza moment would be he comes in, and boy, scares the living wits out of investors and markets. What would you expect to happen in 3 months?
He's certainly in the honeymoon period now. We'll see if it lasts. I think three main things are important. Number one is what ends up happening with trade and tariff policy. Is it a slow roll or is it aggressive and out of the gate strong? Two is what happens with Treasury issuance. I mean, we are rolling, I think, around 25% of debt this year and adding $1.5 to $2 trillion new debt that needs to be issued. So $10+ trillion has to be issued. So the breakdown between coupons and bills is very important, and we'll know in 3 or 4 months if Besant has the backbone to issue more coupon. And then the third would be just Trump in general. Has he done anything wild out of the expected that has actual repercussions? I mean, I think the market has gotten to a point where you take Trump seriously, but not literally. And if it came to a point where we had to take him seriously and literally, and it was something that was not necessarily positive for the economy or markets, then that would certainly be a topic of discussion in 3 or 4 months' time. But that one's impossible to gauge. I mean, nobody really knows what he's going to say or what he's going to do and how far he's going to press it. There are some contradictions with his cabinet, and I think there will be some infighting to see there will be some infighting to determine where policy goes, and we'll just have to see, who wins out.
Yeah. I do remember there's one last question I do want to ask you, make sure I get this in before I let you go. Because of living in Las Vegas, any sort of anecdotal evidence of what is to come based on activity? It's always, it's always boomtown in Las Vegas, but man, when things are bad, they're really bad everywhere. Any sort of anecdotal evidence you're seeing from around the Strip?
Well, we were, I guess, lucky in a sense that the bubble burst in housing well before it did across the nation. So we had a good read on what was happening in the financial crisis, but largely exited all of our financial shares because of it. But that I consider myself more lucky than good in that scenario because of where I was housed and what I was seeing.
Sure.
Today, though, if you go out to the Strip, you go out to a local restaurant, they're still buzzing. There's still a lot of activity. I've heard just anecdotally from some friends that work in the gaming business that they're having to lower rates a little bit in hotel rooms. But again, I haven't verified that. I don't know. But it feels to me when I walk around the city that there's still a lot of economic activity going on. But Vegas isn't a place that you go if you don't have some discretionary capital. So I do think that we're facing a situation where we kind of have a two-part economy where people that are not seeing their real wages increase enough are really being negatively impacted by the inflation that has occurred. And while it's slowed down, the actual price level is not going anywhere but up, versus the ones that have had some capital, had some investments that have seen the wealth effect in full force that are still willing to go out and spend some money. We'll know we're in trouble when, like you said, when Vegas restaurants start to empty out and the casinos aren't as packed and they're offering massive discounts on their rooms. That's when we'll know that there's a serious economic problem.
Yeah. Well, ground floor for that activity. Adam, thanks so much. Where can people find you, reach out to you with any follow-up questions, or even talk about Hightower?
Best place is our website, hightowerlasvegas.com.
All right. Adam, thanks so much. Appreciate all the insight, conversation off record, and all the crazy ideas I send your way, and you always correcting me like, slow down, buddy. I appreciate you.
Happy to do it
so much.
Yeah,
all right.
Thanks for having me on.
All right, everybody, that's a wrap here this week. We'll be reporting from the Vancouver Resource Investment Conference and AME Roundup for most of next week. Have yourself great travels, anybody traveling to the great city of Vancouver, and we'll see you then.